I'm sitting in front of my computer. There's exactly $100,000 in my account. This isn't lottery money. It isn't money my parents gave me. It's money I spent nearly 10 years working for, saving, investing little by little, and saying no to hundreds of things I wanted to buy. And now I have to make a decision that could shape the next 20 years of my life. I have two choices. The first one, use that $100,000 as a down payment on a property worth around $500,000. The second one, put the entire $100,000 into the stock market, mostly through a broad index fund, and let compound growth do the work. I know a lot of people would answer immediately, buy real estate. They're not making any more land. Another group would say, put it all into the S&P 500 and stop overthinking it. But this is my money. I don't want to make a decision based on a sentence that sounds smart. I want to know something much simpler. After 20 years, which option is more likely to make me wealthier? And more importantly, what do I have to sacrifice to get there? I start with stocks. Because stocks are the simpler option, I open an investment account, transfer $100,000 into a broad stock market index fund. Click buy. Done. No real estate agent, no bank meetings, no mortgage paperwork, no roof inspection, no plumbing inspection, no electrician, no tenants. No one calling me at 2 in the morning because the toilet is clogged. I simply own tiny pieces of hundreds of businesses. But there's a problem. It feels almost too simple. So simple that people often don't believe something this boring can make them rich. If we look back over a very long period, starting around 1970, the U.S. stock market, represented by the S&P 500, has produced very strong long-term nominal returns. Using the assumptions in this example, the compound annual growth rate is around 10% per year. 10% doesn't sound insane. If I have $10,000, that's roughly $1,000 in the first year. Pretty normal. But most people underestimate compounding because the human brain thinks in straight lines. Money doesn't grow in a straight line. It compounds. If $10,000 grows by 10%, it doesn't just become $11,000. The important part is that the following year, I earn a return on both the original $10,000 and the profit I already made. Then the year after that, the same thing happens again, and again, and again. Under the long-term assumptions in this example, $10,000 invested around 1970 could potentially grow to roughly $2.5 million over more than 50 years. I look at that number. Then I look at real estate. If I include both property appreciation and rental income, the total long-term return in this model might be around 8% per year. That same $10,000 equivalent might grow to roughly $700,000. So if I only look at pure asset performance, stocks appear to win by a wide margin. I almost have my answer, until I realize I've ignored the most powerful advantage real estate has: leverage. Let's say I have $100,000. If I buy $100,000 worth of stocks, I control $100,000 worth of assets. But if I use that $100,000 as a 20% down payment on a $500,000 property, I control $500,000 worth of real estate. The bank gives me the other $400,000. And that's where the math gets interesting. Let's say the stock market goes up 10%. My $100,000 becomes $110,000. I make $10,000. Great. Now let's say the property only goes up 4%. 4% sounds much worse than 10%, but 4% of $500,000 is $20,000. I only put in $100,000 of my own money. The property increased by $20,000. If we ignore financing costs and other expenses for a moment, that's effectively a 20% gain on the cash I invested. That's the moment I understand why so many wealthy people love real estate. Not necessarily because real estate appreciates faster than stocks, but because they can use other people's money to control an asset much larger than their own capital. A bank is unlikely to lend me $400,000 at mortgage-like terms so I can go buy stocks, but it may happily lend me that money to buy a house. That is a massive advantage, and also a massive risk. Because if the property goes up 4%, I feel like a genius. But what if the property drops 10%? A $500,000 property falls by 10%. I lose $50,000 in property value. My original equity was only $100,000. That means I just took a hit, equal to roughly 50% of my starting equity. The property dropped 10%, but I may have lost half of my money. Leverage doesn't care whether you're smart or stupid. It doesn't care whether you're a good person. When the market goes up, leverage multiplies your gains. When the market goes down, it multiplies your losses too. So I decide to build a more realistic example. I imagine two people, Daniel and Chris. Both are 28 years old. Both have $50,000. Both want to use that money to build wealth over the next 20 years. Daniel chooses real estate. Chris chooses stocks. Daniel uses his $50,000 as a 20% down payment on a $250,000 rental property. He borrows $200,000 on a 30-year mortgage. The assumed interest rate is 7%. His principal and interest payment is about $1,330 per month. Daniel finds a tenant willing to pay $1,800 per month. At first, Daniel is excited. $1,800 in rent, minus $1,330 for the mortgage. That leaves $470. Daniel thinks, I'm making $470 a month while someone else pays down my mortgage. Sounds amazing. That's $5,640 a year. On only $50,000 of starting capital, more than 11%, and that's before any property appreciation. If you stop the video here, you might go buy a rental property tomorrow. But the real world doesn't stop here. Daniel still has property taxes, insurance, repairs, maintenance, appliances break, air conditioning systems fail, water heaters die, pipes burst, roofs eventually need replacement, tenants move out. Sometimes the property sits vacant. Sometimes tenants pay late. Sometimes Daniel has to repaint or renovate the property before renting it again. If the property sits empty for just 1 month a year, that's already more than 8% of annual rental revenue gone. If maintenance costs another 1% to 2% of the property value each year, that beautiful $470 monthly profit starts disappearing fast. Some years, Daniel may even have to put in extra cash. His real cash-on-cash return might not be 11%, it might be closer to 3% to 5%. This is what a lot of real estate content leaves out. People say, I bought this property for $250,000 and I rent it for $1,000. They don't always say, last month I spent $6,000 replacing the HVAC system. They say, my tenant is paying my mortgage. They don't always say, I lost 2 months of rent because I couldn't find another tenant. Real investing is not the best-looking month on a spreadsheet. It is the entire 20-year ownership period. While Daniel is dealing with all of that, Chris is doing something painfully boring. He puts his $50,000 into a broad index fund. Then he adds $300 every month. The market goes up, Chris buys. The market goes down, Chris still buys. The news says a recession is coming, he keeps buying. People say the stock market is about to crash, he keeps buying. Not because Chris knows the future, he doesn't. He simply understands that if his time horizon is long enough and he owns a broad enough collection of businesses, he doesn't need to predict the market correctly every month. The hardest part of Chris's strategy is not fixing houses. It isn't dealing with tenants. It is managing himself. Because stocks have one annoying feature. You can see the value of your investment change every single day. A house worth $500,000 yesterday may effectively be worth $470,000 today. But no one sends a notification to your phone saying, congratulations, you just lost $30,000 today. Stocks do. You open your app in the morning, 0.5%. The next day, 0.3%. 1 month, 0.15%. The market falls 30%. My $100,000 becomes $70,000. I see it. I feel it. I want to do something. And very often, the stupidest thing I can do is sell. That is why stocks are easy to buy but not always easy to hold. Real estate forces patience because it is illiquid. Stocks give you the freedom to sell almost instantly. And sometimes too much freedom causes people to make terrible decisions. 10 years pass. I look at Daniel and Chris again. Daniel has paid down part of his mortgage. The property has appreciated over time. If the area developed well, Daniel's equity may have increased significantly. He used leverage, so even moderate property appreciation could translate into strong growth in his net worth. Chris has also had 10 years of growth. His original $50,000 plus $300 per month plus compound returns. Depending on the assumptions, both of them may end up with surprisingly similar levels of wealth. But then I notice something. Spreadsheets usually say, Daniel, X dollars, Chris, Y dollars. But almost nobody adds another column called hours of life spent managing the investment. Daniel may have spent hundreds of hours on the property, finding it, negotiating, getting financing, managing it, repairing it, inspecting it, finding tenants, solving problems. Chris, he might spend a few minutes each month adding more money. That doesn't mean real estate is worse. If Daniel loves real estate, understands repairs, knows the local market, and considers management part of his work, those hours may be incredibly valuable. But if you want a truly passive investment and you jump into direct real estate ownership, you may be lying to yourself. Real estate is not automatically passive, at least not when you only own 1 or 2 properties and manage them yourself. After 20 years, the difference becomes even more obvious. Under the assumptions in this model, Chris could potentially end up somewhere around $420,000 to $460,000. The actual number, of course, depends on market returns. But the more important point is that his money is highly liquid. If Chris needs $20,000, he can sell part of his portfolio. He doesn't need to sell everything. Daniel is different. If most of Daniel's wealth is trapped inside a $500,000 property and he suddenly needs $20,000, he can't sell the second bedroom. Real estate can be valuable, but it is not flexible. To access the money, Daniel may need to sell the property, refinance, or borrow against the equity. Every option has a cost, but Daniel has something Chris doesn't have: control. Daniel can renovate the property, improve the kitchen, reconfigure rooms, increase rent, find an undervalued property, negotiate directly with a seller, buy in an area he believes will grow rapidly. If Daniel is skilled, he doesn't have to sit around and wait for the market. He can actively create value. Chris may own Apple shares, but he can't call Tim Cook and say, "Hey, I want you to improve the company so my stock goes up 20%. That is a major difference. But real estate has another problem: concentration risk. If I have $100,000 and invest it into a broad index fund, my money is spread across hundreds of companies. One company fails, I still own hundreds of others. One industry struggles, other sectors still exist. But if my entire $100,000 becomes the down payment on one property, I am making a huge bet on one building, one neighborhood, one city, one local economy. What happens if the neighborhood declines? What if a major employer shuts down? What if people move away? What if property taxes increase? What if insurance costs explode? What if rental laws change? Real estate often feels safer because its price does not flash on a screen every second. But not seeing volatility is not the same as not having risk. Then I realize there is a third option sitting between these two worlds: REITs, real estate investment trusts. Through REITs, I can own a small piece of warehouses, data centers, apartment buildings, shopping centers, hospitals, hotels, office buildings, but I can buy them the same way I buy stocks. I don't need to find tenants myself. I don't need to fix a roof. I don't need $100,000 to own a piece of real estate. In the United States, qualifying REIT structures generally have to distribute at least 90% of their taxable income to shareholders in order to maintain REIT tax status. That is one reason income-focused investors often pay attention to them. Of course, REITs are not magic. Their prices still move. Higher interest rates can hurt them. A weak real estate market can hurt them. But they make me realize something important. The whole stocks versus real estate debate is sometimes too simplistic. I do not necessarily have to choose only one. After hours of staring at spreadsheets, I finally understand that my original question was flawed. I kept asking, which one makes more money, real estate or stocks? But maybe the better question is, which type of asset fits the way I want to build my life? If I want high liquidity, low management, easy diversification, the ability to invest every month, no large debt, and I can handle watching my portfolio fall 30% or 40% without panic selling, then stocks make a lot of sense. But if I have stable income, understand real estate, know how to negotiate, know how to evaluate locations, can handle debt, can survive cash flow pressure, want to use leverage, and I am willing to actually operate the asset. Then real estate can be an incredibly powerful wealth-building machine. One side has the power of compounding, the other has the power of leverage. Stocks can offer strong, long-term financial growth with very little day-to-day management. Real estate gives me the ability to control a much larger asset with less of my own money. But both come with a price. Stocks make me pay with volatility and emotional discipline. Real estate makes me pay with illiquidity, work, debt, and concentration risk. There is no magical asset. There are only investors who understand what they own and investors who don't. If I had $100,000 today, I would not ask some random creator online, should I buy property or stocks? Because that person does not know my income. They don't know whether I have a family. They don't know how much debt I already have. They don't know how much loss I can emotionally tolerate. They don't know when I might need the money. They don't know whether I would enjoy managing a rental property. Someone earning $300,000 a year views a $400,000 mortgage very differently from someone earning $40,000 a year. A 25-year-old sees market volatility differently from a 65-year-old preparing for retirement. So there is no single answer for everyone. But there is one thing I do believe. Wealthy investors do not always win because they choose the perfect asset. They win because they understand the rules of the asset they own. They know why they bought it. They know how long they plan to hold it. They know where the risks are. And they don't jump from one asset to another just because somebody else recently made money. Real estate goes up, buy real estate. Stocks go up, sell the house and buy stocks. Gold goes up, sell stocks and buy gold. Bitcoin goes up, sell the gold and buy Bitcoin. If your entire investment strategy is based on chasing whatever just went up the most, there is a good chance you will keep arriving at the end of every trend. That is not investing. That is FOMO. I closed the spreadsheet. The $100,000 is still sitting in my account, but now I'm no longer asking, what is the best asset? I'm asking, how do I want my money to work for me? If I want a simple system, something I can keep contributing to without disrupting my career, stocks make a lot of sense. If I want to use leverage to control a much larger asset, and I am willing to make investing part of my actual work, real estate becomes very attractive. If I want exposure to real estate without becoming a landlord, I can study REITs. I may even choose to own all three. Because in the end, the real battle is not stocks versus real estate. The real battle is assets versus inflation, compounding versus consumption, discipline versus emotion, and time versus impatience. You can build wealth with stocks. You can build wealth with real estate. And you can also lose money with both if you use leverage recklessly, buy things you do not understand, and panic every time the market scares you. No asset can save an undisciplined investor. And no strategy can work if you replace it every 6 months. So if you are standing in front of the same two choices today, don't ask me which one you should choose. Take out a piece of paper. Write down, how much capital do you have? What is your monthly income? How much debt can you realistically handle? Will you need this money in the next 3 to 5 years? Can you watch your portfolio fall 30% without selling? Are you willing to spend hundreds of hours managing real estate? Once you answer those questions honestly, you may no longer need anyone to tell you what to buy. Because the best choice is not hidden inside a YouTube video, it is hidden inside your own financial situation. And to me, that is the answer that matters most. There is no single best investment. There is only the investment that fits the right person, at the right stage of life, with the right strategy. The important question is not whether you buy real estate or stocks. The important question is whether, 20 years from now, you still own good assets. While most people have already sold theirs because one bad market scared them out,